Okay, thank you very much. Welcome everybody this evening to what is going to be a very fascinating, fast-moving and interesting talk. And I usually give a long, weighty introduction, which I've written here, which I'm not going to read because Mr. Tamas has much more interesting things to say and knows a lot more about investment than I do. So without further ado, I'm simply going to introduce Mr. Alexander Tamas.
Wonderful. Thank you very much. Well, I'll start maybe with a quick intro and background to myself. So I've been investing now for 2 decades or the like in mostly technology companies. That has been my field overall. I wanted to do that basically all my life. When I came out of university, I wanted to do mergers and acquisitions in technology in London. That was the dream. The market imploded in 2001, so that didn't work out that way. So I started a company called Arma Partners. They're on top. Then eventually the market came back. I went to Goldman Sachs to help build them, their mergers and acquisitions department in technology. Then I did DST, which is a global investment firm, which I helped to start. There I made some investments in companies like Facebook early on, Airbnb, Spotify, some things in China, JD, Xiaomi, Alibaba, Mail.ru in Russia, and so forth. At VY, my largest position right now, by a wide margin, is SpaceX. It's a company I very much believe in, but we also help to take X private, which is now Twitter, XAI, which just released Grok 3, which I think is pretty cool, Neuralink, the brain-machine interface company. I was on the board of Reddit, which is public now. Zomato became the largest internet company in India. I invested early in Bitcoin. In the crypto space, I'm right now doing something called TON, which I think is exciting. Beyond that, we also start a few things. So we started a cybersecurity insurance company, which is called Coalition. Here we help people to insure against cyber risk. That became the largest insurance company, a cyber tech insurance company, going one in the world. BioGrav is a longevity clinic. So I started that in San Francisco, and we're just opening in New York right now. Synaptic is a data science company. And the Institute is philanthropic. It's gathering interesting people in San Francisco, and it's going well. But the idea is basically investing and starting in mostly tech companies. Let's start off with an interesting question, or what I would think is an interesting question. Would you sell 10% of all your future income for 50,000 euros today? So it's an interesting one because we have to think it through what is a good offer and what is not a good offer. So how should we think about it? Well, the way to think about it is how much cash do you think you will earn in future, and by how much do you discount it to get to the value of it today? That's basically what most investing is about. So first, how do we think about discount rates? Cash in future is worth less than cash today, in general. Right? So why is that the case? Because you can take the cash today and invest it in something. So in the past, the US Treasury bond would give you 8%. You can buy all kinds of things that give you money. If you get it in future, you can't do anything with it today. So if you grow cash over time, let's say you have $5,000, and you grow it at an 8% interest rate over 50 years. If it compounds nicely, after 39 years, those $5,000 turn into $100,000. After 50 years, it turns into $234,000. So this orange curve is compounding. That's the key and the secret to investing. You will notice at the beginning, it doesn't look that much different than the linear one. The linear one is you get your interest paid out every year. It does not compound. But at some stage, it diverges, and then it goes through really quickly. So starting early to save and then compounding is the key to being successful. It mostly never happens overnight. So if you're patient, it'll come. So at the end, the difference between annual payouts and compounding is 9x in this case. The rule of 72, this is a fun one. If you want to know how long it takes for your money to double, you take the interest rate and you take 72 divided by the interest rate. So if something in this case was growing by 8%, you know it's going to double every 6 years or so, or every 9 years. Here at 12%, the rule of 72, 72 divided by 12 is 6. So here the investment doubles every 6 years, right? And here the curve becomes really exciting because over time you'll have 41x the initial one. Your $5,000 will be worth almost $1.5 million. So compounding is important, and money today invested is important. So, we said that. So how much should you pay today for $5,000 in future? That's the inverse thinking. This is discounting. So if I go to you today and say, look, I will make a contract with you. I'm good for my money. I'll give you $5,000 in 10 years from now. How much should you be giving me today if you want to have 8% per year, right? So we plot that curve. That curve says, well, you should give me right now $2,316. This is the net present value of the $5,000 over time. This is really important because this is how you think about cash flows that will come to you in future. So let's do the math on your income. Is 50,000 euros today a good deal or not? Well, let's take the top 10% earners in Italy. That's about 90,000 euros per year. And I would assume Marymount students will be in the top 10%. Let's assume you earn that money between the ages of 24 and 65. Let's assume we do a discount rate of 8%, and we assume there's an inflation of 3% per year. So if I plot that, it looks like this. So until the year 24, I get nothing, and then I'll get 90,000 euros. In reality, at the beginning, you'll get less. At the end, you get more, but I assume it's constant. And then I discount those 90,000 euros back to today. So that would be the curve. If I add up everything underneath this curve, the net present value is about €1 million. A 10% stake would be 103,000 euros. So if I offer you 50,000 right now, it's probably not such a good deal. So that's kind of like how I would think about it. If you think that you're on the lower end of the earners in Italy, then you should try to sell me on 50,000. This is an interesting one for two reasons. One, you are right now the most valuable asset that you have. So it makes a tremendous amount of sense to invest in yourself. That comes to your education, knowing things, learning things. You have a little bit of pocket money, a little bit of savings, but the most valuable asset by far at this stage in your life is you. So it makes sense to invest in it. The second one is this is how investing works. You think about what do I get right now, or what do I pay right now, and what do I get in future. So you're a project. We just went through the project of your life, so to say. And you can make different assumptions and see how much it would be worth. A skyscraper is a project. You say, okay, I'm going to go build this building. It's going to cost me time, effort, and a lot of money. And then afterwards, I'm going to sell the apartments, or I'm going to rent out the apartments. Do I get the cash back that I'm putting in, and what return am I getting? Right? A company is a project. A company, like Roblox or so, does not tell you how much they pay you every year on that thing like a bond or gives you some kind of other yield. It just tells you have a share of this company, you are a share of this project. And then you have to figure out, well, the future cash flows of this business, is it worth as much? If you have time later, we can do a little case study on it, but this is kind of like how to think about these various things. Important, moving in and out of assets is not investing. That's trading. So there are professional traders out there. There are a lot of algorithms out there that trade. In trading, you will never make any money. That I can basically guarantee you. Sometimes you'll be successful, then you lose again. The person or the company that makes money on you trading is your brokerage firm that collects fees. So anyone who goes like, well, the market seems to be overheated right now, or right now is a good time to come in, is trying to time the market. It never, ever works. So don't think about it as investing. I think many of you will try this at some stage and fail and then give up on trading. Investing is owning something for the long term that you really like. And if you own something good, time is your friend, because good things just become better over time. If you own something bad, time is your enemy, because bad things decay over time. So you want to make sure that you do your homework, you understand exactly what it is you own, and then afterwards you can be just patient. Sometimes people have a real big issue with being patient. They confuse activity with results, and they say, well, I haven't done anything, I need to move my portfolio. You really don't. If you have something good, things will come up and down. If you get excited about it when they come up and you get frustrated when they come down, you're not going to have a good time. If you believe in your conviction, you've done your homework, you just need to be patient and things will work out. I would also postulate that owning things is the only way of how to generate real wealth overall. So I would encourage everybody early on in their life to start owning things. That can be companies, stocks, bonds. If a friend of yours is doing a startup company, ask if you can invest a little bit of money, accumulate small little ownership position in things. Why? Because somebody just asked me about SpaceX, if they can put personal money in there. I said, well, yeah, we can figure it out. It's a private company. It's not easy. But every time, there's 15,000 people going to work at SpaceX every day. They work 7 days a week. They work long nights to make the company more valuable. If you own a part of it, all of those people go to work every day for you. It's a wonderful thing to have assets. You will not get rich by renting out your time. If you do something which is time-based, you should do it only if that is your calling. Like, for example, you say you want to go into medicine and become a doctor because you really want to help people, then that is more important, obviously, than how much money you make at the end of the day, and you should go do that. But don't go and say, well, I'll go become a lawyer because it's a well-paying job. And if you're a lawyer, you have billable hours, and there's only so many hours you have in the day. There's a limit as to how much you can do. So think about accumulating wealth is owning assets. It's not selling your time. You sell your time to get some money in that you can then invest. You will definitely not get rich by holding cash. So there's a lot of people that think, well, investing is not for me. It's all very complicated. Therefore, I just keep it in my bank account. It's safe. That is a sure way of how not to get rich. You can see it here. This is the average inflation after World War II between 1945 and today. Blue is when we had inflation. Red is when we had deflation. You can see there's basically never deflation. It's always inflation. What does inflation mean? It means that in a year from now, the $100 you have today buy less things than they buy today. And the central banks of the world have completely given up on saying, we want to have no inflation. They all target 2 to 3%. So an average between 1945 and right now is 3.65%. So the buying power of $100 from 1945 right now has a buying power of $5.46. It's a catastrophe to keep holding your cash and not investing it. So basically, the keys to wealth is own something really good and then be patient and compound. So it's easily said. The question is, how do you own something good? I think there are two good ways to own something good. The first thing is to create something that people want. So you see there's a need in the market. This doesn't exist in the world, and it'd be great if it were, and so you go create that. That's entrepreneurship, and I would be happy to come back next year and to talk about how to start a company and how to grow a company and what's all entailed there. Otherwise, you want to invest in something that other people will want over time. How to identify a good investment. So if it looks like this, where it's all foggy and unclear, and for me, many sectors look that way. If I think, let's say, biotech, where people make synthetic enzymes or so, I have no idea exactly how that works. I'm not deep into it. I don't know the barriers to entry. I don't understand the market condition. I don't even know how large the markets are. I could learn, and it becomes less foggy, but the path to learning here would be pretty long. So when I see stuff like this, and right now for you guys, this is almost everything. But over time, as you get deeper into certain subjects, certain things will clear up. But if it looks like this, do not invest. Don't go into something because your neighbor or your friend or a really smart person said this is a really good investment. You have to do your own homework so you can see clearly. Now, if it looks like this, it's obviously better. The problem here is, let's say, right now AI is on the rise. So everybody knows, GPT and Grok and everything else. So NVIDIA is going to benefit. NVIDIA is going to sell a lot of chips. But you're not a genius for discovering that. Everybody can see that. So it's crystal clear. As a result, NVIDIA is worth $4 trillion. It's probably expensive. When others see fog and you see clearly, that's usually the opportunity to make outsized returns overall. So when I then, this one is, here we go. This one is from my own personal experience. In 2009, I led an investment in Facebook. It was valued at a $10 billion valuation. The company that year that wanted to do $500 million of revenue, they ended up doing 777. But press articles ripped us apart for making the investment. They said, well, what did they say? Mark Zuckerberg is a naive control freak. The ad inventory is lousy. There is no real business model. This was not one headline. This was lots of headlines. There was a headline, don't be fooled, it's not worth 10 billion. And I just decided it's worth 10 billion because I paid it. So you have to be saying like, this is amazing. I love this because other people are seeing fog. I believe I see clearly. Normally, I don't go on the record. I don't like the press, but in this case, I did because I was naive at the time. But I said, I think Facebook is worth every cent of the $10 billion valuation, and it'll be one of the most important internet companies in the world. This was 2009. Since then, the company went from $777 million of revenue to $164 billion. The valuation went from $10 billion to $1.8 trillion. This would be compounding at 39% per year. Airbnb, same thing. We invested, the company was pre-revenue, there was really not much there. We invested at a $1.3 billion valuation. People thought we were nuts. Here's just one of those comments where they say, it's still using training wheels, it's incompetent in running the business, clearly sign of a bubble. It says, even Warren Buffett, who is one of the greatest investors, or the greatest investor of all time, would see, you don't need to be Warren Buffett to see that this is an idiotic idea. The bubble will burst, retrenchment will inevitably follow. This is the fog. The company was worth $1.2 billion at the time. Right now it's worth $88 billion. That's a 73x return, or roughly 37% per year. For the stuff that I have right now, it's the same story. People are saying the boring company, we're just doing tunnels. It's an idiotic business. They're saying stuff like, I'm embarrassed for everybody who's trying to defend it. It's a joke of a transportation company. Neuralink, we're just doing brain-machine interfaces. They say Neuralink hasn't done anything that I consider innovative at all. This was in 2021, and since then we've implanted Neuralink in patients that are playing chess with their mind. Then on Twitter, this was basically non-stop in terms of how dumb that deal was, how it's all over, how we're watching it implode in real time. The advertisers are right now all coming back to Twitter. We have record engagement levels, and there's a lot of products to be launched. I would be very surprised if you lose money there. On SpaceX, even Morgan Stanley, who was very bullish on it in 2020, said, well, we think it's worth $50 billion potentially one day, and on the upside case, $120 billion. This was in, I think, March 2020, and right now the company just did around at $350 billion. I would take any bet right now that SpaceX will be a $1 trillion plus company within 5 years overall. So how do you get clarity? How do you go actually do that if you can't just listen to what other people say? First thing is think. There is so much stuff happening in the world right now. If you can see the things that are happening around you, let's say, what is the impact of AI, right? It's coming everywhere. It's coming to the education sector. It's coming to customer service business, to consulting businesses, and so forth. What's the impact? What do you think is going to happen? What is the impact of decentralized decision-making, i.e. cryptocurrencies and so forth? Or what is happening on the longevity front? Do you think wealth inequality will rise or shrink over time? If it rises, who's going to benefit and who's not going to benefit? It's mostly you being informed about the world and thinking. Once you've done that, you do your research. If you have a field that you find really fascinating, let's say longevity is something that you find great and interesting, well, then it's time to go deeper. You read about what is the market size, what are the companies that are interesting, who are the players in it, both for your potential career, but also to find interesting investments. And then if you identify something and says, that's a really interesting and novel approach, you try to get some exposure by investing. And then be ready. I think that's probably one of the most important things for you to take away. There's not going to be many opportunities in your life that will come along. Warren Buffett said something along the lines, think about investing as having a punch card with 20 holes, and you can only do 20 calls your entire life. So you don't go and start trading in and out of positions. You say, well, this is the one, and I know it's the one, and it's going to be one of my 20 in my life. They will come along every couple of years. If you're not ready for it, you can't play. That's not going to come back that quickly. How not to be ready? This is going to be slightly controversial because it goes against what most people think overall, but it's the own a house myth. And that's something that you will hear a lot. I can tell you right now it's a trap. So the story goes like this, and a lot of people will say this to you over time. Get on the property ladder. Buy something, because, as we said earlier on, owning an asset is a good thing. Why would you pay somebody rent when you can just use the money to pay a mortgage instead, and then afterwards it's yours? At least you own a house. And then house prices generally increase. So at the end, you're not only using the money to pay for the mortgage, at the end you own a house, and that usually goes up in value. So that's the idea. I disagree. So let's go through this why I disagree. Normally, when you buy a house, banks ask you to put down anywhere between 10 and 20% or 30% for a down payment. Let's say you identified something for 750,000 euros. In the countryside, it'll get you a nice little house. In Rome, it gets you a small flat. You say, okay, you're going to work really hard. Saving 150,000 euros is not easy, so it's going to take you probably 10 plus years. Then you go to the bank and say, look, I have all this money now. I want to buy this flat. And the bank says, this is great. I'm going to give you 600,000 euros at a 3.5% interest rate, which is the interest rate that we have right now. So you go buy the house. So let's do the math. So the monthly mortgage payments you're looking at is about 3,000 euros. Over 25 years, that's 900,000 euros. If you own the place, if anything breaks, you have to pay for it. There's a water pipe that breaks, there's the air conditioning stopped working, the water pressure is not enough in the shower, whatever it is, you have to pay for it. And then you have property tax, waste tax, and so forth. So if you put it all together, you pay 150,000 euros. That's all your savings gone. Then you pay 900,000 euros for mortgage. Then you pay, all the rest of the stuff. That's 250,000. In total, you pay 1.3 million euros. And then, when you're 60, you own the house. This is important. If you miss a payment or one too many payments, the bank will take the house. You will have lost everything. The 150,000 euros is gone. Everything you worked for is gone. So if you have a startup idea and say, this would be amazing, we should go do this, the world really needs this, you can't do it. Because you go like, well, if it doesn't work, I'm going to lose my 150,000 euros down payment. I'm in fact going to lose everything. So I just have to keep on doing my job. If a friend says, you know what, it's really cool, I have this gig in New Zealand, do you want to come with me and work there for a year? You will say, no, I can't. I have a house, I have a mortgage, I can't, take that risk. If you hate your job, you think that the people you're working for are idiotic and you don't want to work for them, you can't quit. You have to find an alternative income before you go because otherwise you're left with nothing. There's this saying, most people die at the age of 28, we just bury them when they're 82. That's one of the reasons. You cannot take any risks anymore. I call it neo-feudalism. You basically have to work, whether you like to or not, because otherwise everything disappears. Where do all your dreams go? Well, here. Right? It's a 2-bedroom flat in VR Gemere for 780,000 euros. It's on the 2nd floor with a lift. By the way, house prices, do they always go up? Not really. In the last 25 years, if you do it inflation-adjusted, house prices in Italy are down by roughly 6%. I think the myth that house prices always go up is partly because they went up a lot, because about 100 years ago, the population on planet Earth was about 1 billion. It grew to 8 billion, and we couldn't build enough. So almost everywhere house prices went up. At the moment, you have to be lucky to buy in the right region to have house prices go up. I would postulate that in many outside of city regions, house prices will actually decline. Life plan B, what's the alternative? So you start the same way. You work really hard for 10 years. You have 150,000 euros as an investment. That's important. We saw earlier on how things compound over time. Then you go and do your work as an investor, even if it's not your full-time job, and you identify investments that pay 8%, 10% or more. Then you rent a flat for 2,500 to 3,000 euros net. The flat we just saw that was 780,000, you can rent for 2,700 euros a month. I looked it up. So if you manage to get 8% a year, your initial investment is going to be worth €1 million. Your monthly savings that you don't pay in tax and things breaking and everything else, you invest as well at 8%, that's 700,000. So in total, you're left with 1.7 million euros. If you then take that into a bank account at 8%, that pays you about 11,000 euros a month. If you manage to get to 10% per year, you'll have a total of 2.6 million, and the bank pays you about 22,000 euros a month. You have no sleepless nights in an economic downturn. If all of a sudden the world collapses and JP Morgan goes out of business, you don't have to worry about losing your house. If worst comes to worst, you just move into a small flat for 2 or 3 years until things recover. You're flexible. If somebody says, let's go to New Zealand for a year, you say, sure, let's go and have fun. You can take risks, and I would encourage you guys, as you're young, to take maximum risk. Go into startups, do interesting investments. As you grow older, you have kids, you have responsibilities, you can take less risks. But when you're 25, 26, 30, there is no reason why you shouldn't start trying to start a company. And you can be ready when the opportunity comes. Like we said, opportunities don't come often, but if you have cash on the side, you can actually invest. So how do you get to 10% a year? A lot of people will, you say that to us, say, well, that sounds all really good, Alexander, but my bank gives me 2%. How do I get to 10%? It's not that hard. So here, for example, this is something called private credit, business development companies. They're all public. They're the tickers. You can see for the last 10 years what is the average dividend yield that they have paid out. So on those tickers, you get like 10%, 10.8%. If years are poor, you go down to 6 or 5%. If they're really good, you get 12, 13%. But 10% is a pretty good expectation. If you have access to specialized products from good banks, maybe you do. Here is something from Goldman Sachs. They pay you, well, they achieve 17% return. They pay you 12.8 because they take fees. But you can see between 2008, 12, 15, and so forth, the net IRR we see down there in red is anywhere between 7.6% and 16.9%, with 12.8% on average. So just for fun, we plug in the 12.8% for our house purpose and see the 150,000 euros you saved after 25 years are all of a sudden worth 3 million euros. And in total, you would have 4.6 million euros. You take that and invest it, and all of a sudden, you'll get 50,000 euros a month. That's 6 times more than the apartment would have been. Warren Buffett, the GOAT in our sector, he achieved 19.8% returns for 60 years, which is pretty incredible. There are investors like myself that do well for a decade or so, but to do this for 6 decades is very impressive. So an investor in Berkshire Hathaway usually managed to achieve that. At 19.8%, the numbers become ridiculous. It's like 20 million euros instead of having that house for 700,000. So what are the key lessons from all of this? First, avoid net debt position. So buy a house when you have excess cash. I don't think it's a mistake to always buy a house. Sometimes it makes sense. You want to own something, you want to change a wall, and it's just good not to have a landlord. But don't give up your life for it. When you have excess cash and you say, well, I have 500,000 euros, I'll take 100,000 and make a down payment, that makes sense. If all you have is 100,000 euros, it would be a grave mistake to take all of it into a down payment. Sometimes the markets shift, and then the banks say we'll take you for 0 down payment and basically 0 interest. That has happened before. Then obviously you do it. That's a no-brainer. But in the current market environment, I would highly avoid it. Be a net owner of assets. What I mean by that is if you go all the liabilities you have, any debt that you have, and you put all the assets that you own together, you always want to be net owning assets and not in debt to other people. I think that's a pretty good rule. If you follow it, you're never going to get into trouble. Do not trust investment advisors. They're all charlatans, basically. So if you're really good at investments, you are sitting in New York at a hedge fund, and you make 5, 10, 15 million euros a year. That's the idea. If you're great in private investments, you work for a private equity firm or a venture capital firm. If you work at Mediobanca, at a local branch here in Via Veneto, you are not that. So those people will not give you any sensible advice. What they will do is to say, well, we're going to put you into a well-diversified portfolio, which is going to include some gold and metal and precious metal and a little bit of equities from Europe, a little bit of equities from the US. You're going to be diversified to death, pay a tremendous amount of fees, and your returns are going to be crap. So you're going to look at it, and every year the investment advisor will sit you down and say, well, we're not as good as the benchmark, but we had less risk. And then a bad year comes, and all of a sudden everything drops, and they will make excuses why it all dropped, but everything dropped, so of course your portfolio dropped as well. So you have to do your own work. It will determine how your life goes. If you go to an investment advisor, you will at best get 2 or 3% per year. If you do your own work and say, well, I identified a few things that can pay me 10%, the difference over a 1-year time period is marginal. The difference over a 30, 40, 50-year time period is the difference between having a tremendous amount of wealth and having nothing. Understand the power of compounding. It's something that I think a lot of people do not, because in the near term, it looks so similar, like linear. It's the same thing, by the way, with technology investing, or the Facebook example. These companies do not grow linearly, and a lot of people cannot think exponentially. So they extrapolate linearly and then are surprised when things go better. Don't make that mistake. Understand compounding really well. When you start with a really small snowball and you roll it, at the beginning not much happens, and all of a sudden your snowball is enormous and you can hardly move it. So take investing seriously, do your own research. It's the key overall to hacking life. So just a couple of thoughts about how not to fall in the trap and how to make money. And then the rest, I'm more than happy to do Q&A and walk through either war stories or career or specific sectors or anything you really would like.
Okay, so if we have any questions for Mr. Tamas.
Thank you very much. It was very interesting what you said. I have one main question. How do you differentiate between a bubble and an actually potentially successful investment long term?
Good. I think it's an interesting question because a lot of times when we invest in tech, things look a bit like a bubble. And people get very hyped up about it. And then afterwards, all goes to nothing. Bubbles have a couple of things in common. People typically collectively lose their mind, and you know when that happens. Right now, in AI investing, we have a little bit of a bubble going on. Ilya Sutskever, who's somebody I know well, started a company. He said, this company is not going to have a product at all. We will only come out once we have AGI achieved. And he raises money right now at a $35 billion value. Right? When it seems to you a little bit crazy, I say, well, maybe I'll stay away from that. I find the best way to ignore it is not to get caught up in what other people think. Emerson had this beautiful quote where he said, it's easy to live after your own mind when you're in solitude, and it's easy to live with everybody else in a crowd, but the real thinker, genius, is the one that keeps his own thoughts in the midst of a crowd. And I think that's what you need to do. So if you kind of understand something, for example, scooters, right? That was something where everybody started investing in scooter companies at some stage. I was co-located with another VC in San Francisco, and there were scooters. We drove the scooters around the floor, and they were clearly fun. And everybody said, what's your scooter play? And I said, I think it's a stupid business. I don't have a scooter play. Why? Because at that time you thought, well, in case this works really well, what are the barriers to entry? You buy them somewhere from China really cheap, you launch a website, and you compete. So if somebody charges too much, you're going to charge less. So I understood how scooter companies would make revenue. I did not understand how they would make a profit. So I said, will definitely not have a scooter play. I stayed away from VR stuff in 2014, 13, 15 as well. I could just not understand or see people sitting with this massive thing in their face for 10 hours a day. I thought maybe one day, but being too early is the same thing as being wrong. I did not participate in NFTs. That was at some stage a massive craze, and I looked at it and said, it's like, this is a JPEG, So I think there's going to be use cases for it, but I'm not sure it's going to be worth like a million euros for this JPEG. So if it doesn't make sense to you, don't go down that path. AI is a little bit more complicated right now because there's actually a revolution happening. It's actually interesting, and you want to be exposed somehow. But the same people that bought NFTs, scooters, and everything else, they're right now buying AI. So the number of companies I said no to in that sector in the last year is a large amount overall. But if you do your own work and own research, let's say the initial Facebook investment, I thought, well, what do I need to know? What do I know that other people do not know? The public did not have cohort data analysis. Cohort data means out of 100 people that sign up right now, how many people are still using the service a month later, 6 months later, a year later? Whenever you look at internet companies, that's a secret, and they don't report them in the public. But that's a secret to understanding whether that company is going to go well or not. So if you have cohorts where out of 100 people, there's still 20, 30 active after a year, that's not bad. If it's less than that, it's going to implode. Facebook had a phenomenal curve, and I owned a few businesses in it. We operated a few social networks across the world, and what Facebook had, I've never seen before. So after day 1 or 2, it dropped down to 50%, then it kind of like dropped to 40, then it kind of like leveled out a little bit, then it started rising to 50, then to 60, and then it rose to 70. You had a smile curve as a cohort. What that meant was, as more people came on Facebook and saw more people there, more people came back and started using the platform. And then I saw that they were signing up about 1 million people a day. So I thought, okay, well, these are 1 million people, out of which, call it 600,000 are going to still be active in a year from now. Then you say, well, they do the US right now, and here are the other countries that they're targeting. I put all that math together, and I said, well, they're going to be at 1 billion users by year X. We had a really sub-optimized social networks in Latvia. We made $5 per user per year in a country with $2,000 GDP per capita. and Facebook had all of the US and most of Western Europe, so they would certainly make more than $5. So I said, okay, let's be conservative and say they make $10. At $10 a billion users, you're at $10 billion. These companies run at roughly 50% EBITDA margin. That's the margin of your profit. That's $5 billion of profit. These companies in a bad market trade at 20 times that profit. So 5 billion times 20 is 100 billion. And I could invest at 10. And so I thought, I don't care if other people say it's a bubble, not a bubble, whatever else. All of that is meaningless because I know roughly how much money this company is going to make. When we talked about how do you think about your earning in future, or how do you think about a skyscraper earning or Roblox earning, it's that idea. At some stage, money has to come back, right? If you can see it coming back and it's just everybody else is running into it, likely a bubble. If you think here's the path and here's how much is going to come back and here's how much by when, then I think you just go for it.